You have a backtest curve that looks like a textbook, but the moment you go live, it turns ugly. Many AI quant projects spend hundreds of hours on prediction and just a few lines of code on execution. They assume that if the model outputs a positive signal, the system buys at the ideal price. If negative, it sells cleanly. Real markets are not like that. In a backtest, a price is a number. In live trading, a price is a process. You see the final fill at $10, but you don't see how long the order waited, how much was filled, how many times it was cancelled, whether it moved the price, and what risk the unfilled part left on your book. That's why projects like NautilusTrader and VisualHFT matter. They answer a harder question: how does a research idea travel through market data, orders, exchanges, and accounts to become a verifiable P&L? Today we break down the 6 gates between backtest and live. The first gate is time and events. Simple backtests often use a loop: read today's closing price, compute a signal, and assume you fill at that same close. This creates a subtle time travel problem. The close is only known after the market closes, but the window to trade at that price may have already passed. Event-driven systems treat market updates, signal generation, order submission, exchange confirmations, partial fills, cancellations, and position changes as distinct events. Each event has a precise timestamp and state. The strategy can only act on information that has already occurred. This may seem more complex, but it eliminates a huge gray area. When exactly was the signal generated? When was the order actually sent? How much did the price move during that latency? Without answers, your backtest and your live system are not the same strategy. Event-driven architecture is the foundation that forces you to confront these questions. The second gate is the order lifecycle. Research scripts often have only buy and sell. Real orders have states: submitted, acknowledged, partially filled, fully filled, cancelled, pending cancel, rejected, and more. Suppose your strategy wants to buy 10,000 shares, but only 3,000 fill. What do? Chase the price, wait, cancel, or recompute based on remaining risk. If the system mistakenly assumes full execution, subsequent hedging and position tracking will be wrong. A mature trading framework must keep order state and account state consistent, and handle duplicate reports, out-of-order messages, and network reconnections. The worst thing a trading system can face is not a small loss on a single trade, but a mismatch between what the system thinks it holds and what the broker's account actually shows. That mismatch can lead to unhedged exposure, margin calls, or even catastrophic losses. The third gate is transaction costs. The most obvious are commissions and the bid-ask spread. But below the surface lie slippage and market impact. Slippage is the difference between the expected fill price and the actual fill price. Market impact is the price move caused by your own order. When your strategy is small, impact may be negligible. As size grows, liquidity thins, or trading clusters, costs rise non-linearly. In backtests, deducting a few basis points per trade is only a rough approximation. Professional research runs scenario analyses based on participation rate, volatility, spread, order type, and time of day. For high turnover strategies, gross returns are just the tip of the iceberg, costs can be the massive submerged part. Remember, returns come from prediction, but profits are prediction minus implementation costs. The fourth gate is market microstructure. Tools like VisualHFT let you see the live order book and market depth. The best bid and ask are just the first layer, behind them are resting orders at different prices. When you submit a limit order, you must consider your queue position. When you submit a market order, you consume liquidity across multiple price levels. Order book imbalance, trade direction, and cancellation patterns may contain short-term information. But this information decays quickly and is highly sensitive to latency, data quality, and exchange rules. A strategy that works on a historical order book may completely fail live because of network delays, queue position, and fee structures. This is why high-frequency trading is not just running a daily strategy faster. It's a different set of data, infrastructure, and risk problems. For most traders, the lesson is to study microstructure and execution discipline, not to copy HFT returns. The fifth gate is Backtest-Live consistency. Many teams maintain two separate codebases, one for backtesting, one for live trading. Over time, the logic drifts. A boundary condition is fixed in the backtest but not in live. Live adds a risk limit, but the research report still uses old rules. Event-driven frameworks like NautilusTrader aim to reuse strategy logic as much as possible, so historical replay and live execution go through the same event interfaces. Perfect consistency is hard, but differences must be explicit, testable, and recorded. What you need to compare is not just code, but also data latency, fill models, trading calendar, corporate actions, fees, and order rules. If any one assumption differs, results can diverge. A simple formula to keep in mind: live PNL equals backtest PNL, model drift plus execution gap plus data differences. The sixth gate is risk control and observability. A system that can place orders must first learn when not to place them. If market data latency exceeds a threshold, pause. If account position doesn't match, pause. If daily loss exceeds a limit, reduce risk. If the exchange sends repeated large orders, stop. If the model output is too concentrated, trigger an alert. This requires a kill switch, a mechanism to quickly stop new orders and enter a safe state. Risk control is not a slogan, it's a set of deterministic rules that a strategy cannot bypass. The model can propose positions, but the risk engine must have veto power. At the same time, the system must have logs, metrics, and tracing. Every order should be explainable: which signal, which filters, where it filled. Otherwise, when you lose money, you only see the equity curve falling, but you don't know if it's a model error, data error, execution error, or account error. This leads to TCA, or transaction cost analysis. TCA is not just counting commissions. It compares actual fills against a benchmark, arrival price, decision price, closing price, or other. This tells you where the loss occurred, waiting for a signal, order type, market impact, or opportunity cost. If your research predicts 20 basis points of alpha, but execution consistently loses 15, optimizing the model may be less effective than fixing execution. TCA turns the vague feeling that execution was bad into a quantifiable, attributable engineering problem. The formula is simple: implementation shortfall equals benchmark price, actual fill price, asterisk shares plus opportunity cost. By breaking down the shortfall into delay cost, spread cost, and impact cost, you can pinpoint the weakest link in your execution chain. To move from research to real money, I recommend a staged rollout. Stage 1 is historical replay with realistic latency, spreads, and fill models. Stage 2 is paper trading, live data, virtual fills. The focus is not on returns but on whether signals are generated on time, order states are stable, and positions reconcile correctly. Stage 3 is shadow mode. The system generates real orders but does not send them, comparing them against what actually could have filled. Stage 4 is a small capital allocation with strict per trade, per day, and total risk limits. Stage 5 is gradual scaling. Each increase in size requires rechecking impact, capacity, failure modes, and costs. Scaling is not just multiplying position size, it's revalidating that the strategy is still the same trade. If you skip stages, you risk blowing up your account and losing the confidence of your investors. The model decides what you want to earn, that's a direction problem. Execution decides whether that money actually lands, that's a technical problem. Risk control decides whether you get another chance, that's a survival problem. An AI project that can read news, write reports, and give directions only covers part of the research workflow. Only by adding event-driven architecture, order management, fill modeling, account reconciliation, monitoring, and risk controls do you approach real trading infrastructure. A strategy is not a signal, a trading system is not a backtest script. The difference is the difference between a hypothesis and a product. Professional engineering is not about making everything never fail. It's about making errors discoverable, impacts limited, processes recoverable, and results traceable. The 6 gates we've discussed are not just technical hurdles, they are the difference between a beautiful backtest and a profitable live strategy. Each gate can turn a pretty curve into a loss-making reality. The model decides what you want to earn, execution decides whether you actually get it, and risk control decides if you get another chance. In the end, the most important thing is to respect the process, start small, validate every step, and always have a kill switch. That's how you turn research into a sustainable trading business. We've walked through the 6 gates that separate a backtest from a live trading system. From time and events to order lifecycle, costs, microstructure, consistency, and risk, each one is a potential failure point. The key takeaway: a model is not a strategy, and a backtest is not a trading system. To succeed, you need to build the full infrastructure: event-driven, order-managed, cost-aware, and risk-controlled. Start with historical replay, move to paper trading, then shadow mode, then small capital, and scale only after validating each step. Remember, first talk about risk, then about returns. We'd love to hear about your own experiences bridging the gap between backtest and live. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.